Anyone can relate to this. You see a beautiful stock chart, so you buy a call expecting the stock to continue the momentum and boom, Murphy's Law, and the option expires worthless. So you change your stance and you buy a put, and what do you know? The stock hits short-term support and rallies and ends up trading in the same place. Well, today's your lucky day, as I am going to show you how to profit from the market's indecisiveness through the option trading strategy known as the Iron Condor. Welcome to today's Iron Condor Masterclass. These are today's topics, and without further ado, let's dive straight into the video. An Iron Condor is often used as a market-neutral option trading strategy, and it comprises of two credit spreads, a bear call spread and a bull put spread with the same expiration date. Traders essentially place an Iron Condor on stocks which are range bound, and if the stock does not move much, they will earn from the time decay, as both their credit spreads would expire worthless. In order to open an Iron Condor, we first have to identify a range where we feel our selected stock will never go above or below. We will then sell an out-of-the-money put option at the lower end of the range and simultaneously sell an out-of-the-money call option at the higher end of the trading range. We are selling these two options as we are placing a bet that from now till the option's expiration date, the underlying stock will remain within the confines of both our sold call and our sold put. And should we be right, we will be able to keep the premiums of both our sold options. However, opening these sold positions will expose us to a lot of risk, and therefore, to mitigate that risk, we will also be buying a call and a put that's a few strikes away from our sold position as protection. This in essence is an Iron Condor. Let's now put this knowledge to practice. This is the chart of Tesla on Marketclub. As you can see, in the month of May, it has been caught trading within the range of $600 to $800. At one glance, we can see that there is both the 100-day moving average as well as the 200-day moving average providing resistance, and there seems to be some support at the $600 mark as well. Let's say we wish to place a bet that for the next 44 days, Tesla will remain confined between $900 and $600. We can do that through an Iron Condor by selling two credit spreads simultaneously. The first credit spread will be our bear call spread, and it comprises of selling the 26th of August call with a strike of $905 and buying the $915 call with the same option expiration as a hedge. The second credit spread will be our bull put spread, and it comprises of selling the 26th of August put with a strike of $490 and buying the $480 put, again with the same option expiration date as a hedge. As you can see, doing this will net us a credit of $200. What this means is that from now till the 26th of August, should Tesla remain below $905 and above $490, both our spreads will expire worthless, and we will pocket the $200 premium collected. Of course, you may be wondering, what if we are wrong and Tesla were to trade above our range? This is where our bought options will come into play. Let's say Tesla were to rally above $915 or tank below $480. If that were to happen, we will experience maximum loss from our affected spreads, as the difference between our strikes are $10. Hence, the maximum that we will lose should we only open one position will be $10 times 100, and that equals to $1,000. But we pocketed $200 from opening the Iron Condor. Therefore, should this scenario happen, we will lose $800. Hence, we are risking $800 to earn $200 in 44 days. And that will work out to be an expected return of 25% in 44 days. I have been using THINKORSWIM for placing all my Iron Condor trades. And what I like about the platform is that it automatically calculates the maximum profit and loss that I will experience for each trade. By the way, if this tutorial is benefiting you, please click the like button and help share it to anyone who might benefit from this tutorial. Let me now show you how to place the Iron Condor via the THINKORSWIM platform. This is the THINKORSWIM account. I'm using a demo account today for this example. In order to place an Iron Condor, we will first have to click the Trade tab and key in the ticker symbol. Let's use the SPY for today's demonstration. The first step will be to choose our options expiration date. Let's choose one that expires in 36 days. and that will be this chain over here. For those who are using THINKORSWIM, I will recommend turning the probability in the money tab on. This is done by clicking the layout button. Over here, click customize, and if you were to scroll down, you will see probability in the money. You select it and click OK. This tab will show the chance of our strikes to be in the money during the option expiration. Let's say I want my SPY calls to have a 13% chance of expiring in the money. That will be the $400 strike. So let's proceed to sell the $400 call and buy the $401 call as a hedge. Notice that we will sell at bid and we will buy at ask. By the way, in order to select multiple tabs such as this, we will first have to hold down the control button for our Mac. Next, let's head down to the put section and do the exact same thing. Let's find a put that has a 13% chance of expiring worthless. That will be the $330 strike. Let's proceed to sell it by selling at the bid, and let's buy the $329 put as a hedge, and we will do that by buying it at ask. For this trade, you will notice a credit of 0.24. If you're okay with the credit, click confirm and send. As you can see, THINKORSWIM will share what the maximum profit will be, which will be $240, and what the maximum loss will be, which in this case is $760. It also shows us where the SPY must be at option expiration date for our trades to be profitable, and in this case, the SPY must be between $329.76 and $400.24. So if you are happy with this order, just click send. And there you have it, an Iron Condor. Now that we all know how to create an Iron Condor, let me now show you what I will look out for before placing an Iron Condor. And if you enjoy content such as this tutorial, then do consider subscribing to this channel, as I plan on releasing an option related video like this every month. The first thing that I will look out for will be the stock's next earnings. Before placing an Iron Condor, it is good to take a look at when the next earning date will be held. I personally do not like placing a condor in between earnings, as we do not want an earnings surprise to cause any large movements in the underlying stock. You can find the earnings date on various websites and applications. My go-to app will be the CNBC app, and I will key in the stock ticker symbol, and the next earning date can be found in the events column. Secondly, I will list down key supports and resistance on the selected stock. Taking my earlier example of Tesla, I will identify various supports and resistance and set my bear call spreads above resistance and open my bull put spreads below support. Here are some supports and resistances that I look out for. Moving averages, in particular the 200-day moving average. I also like to identify a stock's previous highs and its lows. Round numbers, I always feel that people naturally place stop orders or have target prices at round numbers, and hence these round numbers tend to act as strong support and resistance. I also use the trend scores in my technical screener Marketclub to skew my condors to be either mildly bearish or mildly bullish. Therefore, if the scores are bearish or bullish, I will adjust the strikes of my spreads accordingly. Lastly, I like to enable the Bollinger Bands in my charts and place my spreads outside the bands if possible. I notice that stocks tend to have a tendency to bounce within the band's envelope, and therefore I like ensuring that my spreads are out of the band's envelope. Comment below if you guys would want a more in-depth tutorial on how I use the Bollinger Band in my Iron Condor strategy, and I might consider doing one in future videos. By the way guys, I just want to quickly share my technical screener Marketclub. It is a screener that allows you to find bullish and bearish stocks and crypto in just a few clicks. In addition, it provides entry as well as exit signals, thus eliminating the emotional attachment to a trade. You can also monitor your trades by placing them into a watch list, and this helps you have a good idea as to whether the trend is still in your favor. You can try Marketclub for 30 days with just $1 by using my affiliate link down in the description below, and with that, let's head straight to the video. Now, what should you do when the trade goes against you and the stock were to move towards the sold strike? If that situation were to happen, you can either do nothing and just pray that the stock reverses. In the event the stock were to go past the spreads that you open, you will experience the maximum loss of one part of the trade. Let's take a look at our dear example of Tesla. As you can see, should the stock end above $915 or below $480 on the option's expiration date, you will experience maximum loss. In fact, sometimes you'll notice a stock gravitating towards the sold strike only to reverse at the last minute. Alternatively, you can consider closing the affected sold positions and letting the bought positions run. Let's take a look at our example of Tesla again. Let's say that the stock were to tank and you are dead sure that it is going to continue tanking. Then you can take a more aggressive stance by buying the sold put back and letting the bought put run. My preference is to place the stocks that I am monitoring in a watch list using Marketclub, and I will pay more attention when I see a strong bullish or bearish trend start to form. Depending on my risk appetite, I may buy the sold leg back and letting the bought leg run. However, just some real talk, I have tried this strategy a couple of times, and maybe it's just me, but 6 times out of 10, the stock reverses direction at the very last minute and you are left with losses on both your sold and your bought positions, which to me is really a double whammy. What I prefer doing is to close my sold positions when there is hardly any value left in them and letting the bought leg run. Buying your sold positions effectively takes risk off the table, and at the same time, the remaining bought leg will serve as a lottery ticket. As you never know, you may really get lucky and earn from that bought leg as well. Upon placing an Iron Condor, I will also place a contingent order to automatically close my spreads if the stock were to touch the sold legs. This acts as my stop loss and it prevents me from experiencing maximum loss, thus ensuring that I live to trade another day should the unexpected happen. Let me now show you how to create a contingent order using the THINKORSWIM platform.
And in order to do so, select the $330 put and the $329 put, right click it, click create closing order and click the first option over here. You'll be brought to this order tab, find the gear icon over here, click on it and you will see price rules, ensure that it is market, time in force, click good to cancel. Next, head down to the symbols, you'll notice that it will auto-populate the SPY, the method, just put it as mark, the trigger less than or equal to, and the threshold, we want it to be the strike of our sold put, which in this case is $330. Once you are done, click tab and you will notice the description will change, and essentially what it means is that we will buy the bull put spread at current market price when the following condition is satisfied, and that is when the mark price of the security, which in this example is the SPY, is less than or equal to $330. Click save, head down to this button which is confirm and send, click on it and click send. Once everything is done, you'll notice that there is a sell and buy order over here, and that shows that our contingent order for the bull put spread has been done. Now let's do a contingent order to close our bear call spread should the SPY trade above our sold call of $400. And in order to do so, select the $400 call and the $401 call, right click it, click create closing order, find the option over here which is buy, click on it once. You'll be brought to the same order tab, find the gear icon, change the price rules to market, the limit price, ensure that it is good to cancel as we want this order to last all the way till expiration. The symbol will auto-populate as SPY, method, ensure that it is marked, the trigger more than or equal to, and we want the threshold to be the strike of our sold call, which in this case is $400. Once you have typed in the correct figure, click tab, you'll notice that the description will change and this order will be submitted to buy back our bear call spread at the current market price when the following condition is satisfied, and that is when the mark price of the security, which is the SPY, is greater or equal to $400. Click save, find the confirm and send, click on it, you'll be brought to this order confirmation, click send. And if we click the monitor, you'll notice that now there is a contingent order for our bull put spread and our bear call spread. And there you have it, how to create a contingent order.
This is a quick update on the Iron Condor placed on the SPY. We placed this trade on the 14th of July and earned a credit of 0.26. The amount of credit received per Condor was 0.26 multiplied by 100, which equals to $26. As we sold 10 contracts, hence we pocketed $260. The maximum loss for this trade per Condor would have been $1, which is the difference between the strike minus 26 cents, which is the credit received multiplied by 100. That will work out to be $74. As we sold 10 contracts, we were risking $740 to earn $260. Unfortunately, on the 22nd of July, the SPY rallied hard and hit the sold strike of our bear call spread. And as a result, the contingent order set by me caused THINKORSWIM to close that spread at a debit of 0.56. Hence, you can see that setting a contingent order can help minimize our loss, as we paid 26 cents, but as things did not go to plan and the SPY went above the upper boundary of our trade, we did not lose the maximum loss of $74 per condor, and instead we just lost $30 per condor, which is effectively 0.56, which is the debit paid to close the condor, minus 0.26, which is the credit received, and multiplied that by 100. And this is the reason why I always place a contingent order. You can spend hours doing your analysis and due diligence, but if things don't go to plan, it ensures that you live to trade another day. By the way, YouTube wants you to know that this video here will really benefit you, so please go watch it now.